Good morning. Today is Thursday, May 7th, 2026. I'm Joe Terril, president of Terril & Company, private wealth managers, headquartered in St. Louis, Missouri, with approximately now right at $1 billion in discretionary assets under management. With me today is our investment committee. To my right, Kristen Wood, Dave Carter, across the table, Russ Phillips, Bill Newbold, and I already told you who I was. Let's get right into it and chat about the economy. We have always a macro down approach at Terril & Company, and certainly we continue to see a very resilient economy. With things like gasoline prices, with the war going on, with the incredible cost of food at the grocery store, in my humble opinion, maybe the economy is going to weaken. We'll be watching very closely for that, but at the moment it seems like we were talking earlier about some of the trade unions. The electricians, bricklayers, carpenters, plumbers seem to have all the work they want, and we don't see a weakness yet in the economy, but we're watching very closely for it. So with that said, let me turn to you, Kristen. I know you enjoy reading everything you can about what's going on in the economy in the moment, and you and your family are out there in the world living in the economy. You see any signs of a slowdown yet?
Well, I would agree with you. I think the economy is still strong. It will be interesting to see coming up on the summer months with, the oil prices and everything like that. If people are taking vacations, are they going to be driving, flying? Now you have to factor in even more, the price of drive-through. We were just talking about Shake Shack. If you want a burger, fries, and a drink, it's $20. If there's 4 of you, that's $80 for lunch. Yeah. So things are getting more expensive there. I think people are very aware of the economy. Have I seen people slow down as much as you would think? No, I think people are still spending the way they want. But like you said, I just went to the store and I got turkey and grapes, and a bag of grapes was $10. So, it's really what I wanted, so I still got it, but next time I might get apples instead.
Let me ask this. Do you see anybody out there worried about their job that's thinking we're not going to spend because I'm worried I might lose my job, or anybody maybe that for any reason has already lost their job?
No, not as much. I really think we're more like, one day at a time. People aren't looking, they're not looking ahead as much. Until it happens, that's when they'll be concerned. For now, it's hard to slow down your life and cut back when you're just trying to get through the day.
Let's turn then, our approach, as I said, about the economy is it's going to continue to stay strong. We'll go around the table maybe this way. Dave, one of the concerns over interest rates is the amount of money that the government has to finance, as well as what's going on with interest rates around the world. Chat about that for a few minutes for our viewers.
Thank you, Joe. Yeah, it's fascinating because is this expectation that rates should be going down and that they are too high. Saying that, we've talked about this before. The Japanese long-term rates are at historic highs, 20-year highs. The Japanese have just increased their version of the federal funds. Australia, likewise, has increased their rates 3 times, along with the UK increasing their rates. And that's because the economy is strong, and their economies are strong, along with having to finance debt. One thing we're looking at is some refunding coming up. There's a $500 billion bill auction going on this week. that should be, that should go fairly well. But there's 125 billion in notes and bonds next week, of which there's a 10-year and a 30-year tranche. And the 10-year is up at a 435, 440, towards the recent highs. It'll be interesting to see how well the longer end bonds are received.
Yeah, I would certainly point to people and say selling a 90-day treasury bill to the rest of the world is one thing, selling them a 30-year bond is quite another.
And I'm starting to see investment-grade corporate bonds on, say, a 3-year, duration close to 5%. And I haven't seen that in quite a while. And then market expectations for the U.S. and Fed funds, basically, now the market's the odds are an increase, not a decrease. For this year. And why is that? Well, price of oil is up, inflation is, with the economy, what was the GDP number, close to 3% the last print? And if it weren't for the war, you'd probably have it close to 5%.
Well, I'm going to switch, and I'm going to skip you a second, Russ, to get to Bill, because the thing that all of us in Terril and Company's official prediction, if you will, is longer-term interest rates are going up, they're not going down, and by the end of the year, we look for a meaningful increase in the longer-term interest rates. But, Bill, the thing that we want to know is how high does that 10-year U.S. Treasury rate have to go before it's going to affect the stock market, in your opinion?
Yeah, great. Thanks, Joe. And to try and tie all these themes together, David's mentioned that he's starting to see some corporate bonds approach the 5% area. To answer Joe's question, I think a 10-year Treasury bond approaching 5% would be more concerning for stocks. The 30-year Treasury is approaching it now, but the 10-year Treasury is probably the most watched Treasury bond in the market, and so something in the 5% range for the 10-year Treasury would be more concerning for stocks. But to tie in what Kristen said, the themes have been consistent in this market. The economy's resilient. Earnings have been very good so far in Q1. They're up 27% versus last year. 83% of companies are beating expectations. We're seeing companies come out and say, we haven't seen anything yet. Disney's theme parks are still packed. Their cruises are packed. So right now there really hasn't been what we've seen, any sort of destruction in the economy, but obviously we watch it closely every day.
But Bill, you're talking about the earnings and,
Yeah.
and earnings increases, but isn't it not true that like 75% of the growth in earnings comes from the AI and AI-related
That's correct.
economy?
So David brings up a good point. The earnings growth is very concentrated. It's a select number of stocks that are really kind of driving all of this. So that's a little bit, that's another risk in the market. More companies need to be participating.
Now I'm going to switch to you, Russ. Russ is our technician and also follows any number of indicators very closely. Again, I'm concerned about the volatility that we see. This just isn't normal, and it's not my age. I'm here to say the volatility that these markets and individual issues have isn't normal. And I don't know whether that's an indicator, but Russ, let me turn it to you. And what saith you?
Well, thank you, Joe. I think we can all say the volatility's taken its toll on all of us except for maybe Kristen. But volatility's here, and whether that's because of the algorithmic trading we've talked about, which fund flows and how fast the flows move around today is far greater than it was just 3 years ago. Bill and I were commenting the other day, you're seeing year-long moves in stocks in a day, right?
That's for sure.
And so, is that volatility going to go away? We don't think so. We think it's here to stay. To me, this does feel somewhat later cycle. There's an argument on that, I know, but it definitely, to David and Bill's point, has to do with the AI trade and technology stocks. But I think the volatility's here to stay. I think we've talked about the economy. Kristen touched on it. Bill touched on it being resilient. The economy does seem to be resilient. Stock market has had a nice recovery off the lows, again, pointing to that volatility. But a lot of that's been driven by the AI trade, right? If you look at where the real volatility, and you can even look at Fortinet, which is a security software name today, that stock's up double digits today. And that is what we're seeing. There, by the same token, Joe, I thought your point was well taken, and we take this very seriously for client portfolios. You know, there's also stocks that are down double digits, and we don't want our clients to have to experience that. So we're watching the economy very closely for any signs of weakness. We do believe there, to Kristen's point, I think costs, people are definitely aware that our costs are higher. I think they're making some trade downs. But as long as the stock market continues to help the higher end, more affluent people spend money, and you know, people have jobs, knock on wood, like you said, laborers and electricians, because of the AI trade, the economy's going to continue to hang in there.
We'll stop there for today, and thanks everyone for tuning in, and we'll be back in a couple of weeks with another video, or as needed if major events happen. Thank you for tuning in.